Nurturing a desire to retire early could be a new fad among millennials, but not many are fortunate enough to do so. The major hiccup they face, or would face, is the lack of sufficient savings to make that happen. Investors are, therefore, advised to follow a proper strategy and stick to a balanced portfolio to accumulate a sufficient amount of savings. We explain why it's indispensable to keep sufficient equity in the portfolio while you save for retirement. The strategy entails keeping a higher allocation to equity while you are young, and whittle it down gradually in favor of debt as time rolls on. And when the age advances, would-be retirees are recommended to take a complete shift to fixed income instruments. But some conservative investors who swear by the time-tested potential of real estate argue that investing in a fixed asset is more assuring than investing in risk-prone equity assets. Upon seeing the data closely, it is not difficult to realize that having too much faith in the growth of reality is being too insulated from reality. The latest RBI's All India House Price Index in the 10 Indian cities shows that the average return from owning real estate over the last decade has been 11.6% per year. Also, with fixed deposit interest rates hovering around 7.5%, some investors have renewed faith in fixed income instruments. So, should conservative investors rely on more reliable assets when it comes to saving for retirement? Well, not really. Advise Wealth Advisors. S. Sridharan, founder and principal officer of Wealth Ladder Direct says, if you factor in tax and inflation, debt gives a negative return on capital. And real estate has liquidity risk, among others. There are other concerns such as forgery, etc. that can happen in real estate deals. On top of it, when you invest all your savings in one property, there is a concentration risk also. Also, real estate is cyclical, and if you look at the past 8 to 10 years, it has not grown that much, which one would like to believe. For those who want to borrow money to buy a property have to cough up an extra 9 to 10%, and the eventual returns turn out to be marginal. Investment advisors recommend buying equity mandatorily to save for retirement. Abhishek Dev, co-founder and CEO Epsilon Money Mart, say that investing in equity is important to inject diversity into a portfolio. Dev said, while equity has helped quite well in beating inflation in the long run, a balanced view, for example 60% in equity, 20% in debt, and 20% in alternative investments, could be a viable option for longer-term portfolio, minimum 5 years, and help you plan for your retirement. So, it is rational to say that investors should try to maintain a balanced portfolio by investing in equity, debt and alternative assets.